Americans have jobs, they're getting raises, and none of it is enough to keep up with the rising cost of living. The share of U.S. adults who said they were doing at least okay financially fell sharply last year to 73% from 78% in 2023, according to the latest Federal Reserve Survey of Americans' financial well-being, released on Monday. Some 35% of Americans said they were worse off than a year earlier, up from 20% in 2022 and the highest share in the 9 years. The question has been asked. Just 19% of respondents said they were better off than a year earlier. The erosion in financial health was broad-based, cutting across racial and ethnic lines, educational categories, and income groups. The data from the Fed's survey of household economics and decision-making echoes other surveys showing that Americans feel glum about the economy and their own finances. But it provides new details on how the economic crosscurrents of a strong job market and rising prices are affecting families. The job market is by many measures the strongest in decades, with the unemployment rate hovering near a half-century low, job openings near record highs, and workers feeling empowered to demand higher pay. The benefits of that environment are clear in the Fed survey. Respondents said they were more likely to have demanded and received raises and promotions than in previous years and less likely to have lost a job. About 33% of respondents said their incomes had risen in the past year, up from 30% in 2022. But those gains were overwhelmed by rising prices. Only 49% of Americans said they spent less than they made each month, down from 55% in 2022. Nearly two-thirds said they used less of a product or stopped using it entirely because of inflation. More than half said they saved less. The hottest inflation in 40 years is taking its toll on families, with 3/4 of middle-income Americans saying their earnings aren't enough to pay for their cost of living. The financial strength of American households is key to the U.S. economy, given that consumer spending contributes 2/3 of GDP. But surging prices for everything from gasoline to groceries are eating away at family budgets, with the financial services firm finding that 7 in 10 middle-income consumers are cutting back on restaurants and takeout meals, while about the same share plan to skip upgrading their phones and other tech because of inflation. Real wages are losing ground as inflation flares, eroding consumers' purchasing power. The share of middle-income Americans who say their incomes aren't keeping up with their cost of living has jumped 16 percentage points. To stay afloat, more middle-income Americans are relying on credit cards, Primerica found. About 29 of those surveyed said their credit card debt had increased in June, reflecting the highest share since the survey began, the company said. But the longer that goes on, the longer those balances bulk up. That creates a hurdle that can be difficult to overcome in the future. A new LendingTree survey finding that 43% of Americans expect to add to their debt in the next 6 months. The share was highest for parents with children under 18, with 58% expecting to take on debt in the second half of 2023.